Hi again, I'm Bob Henderson. I'm the Nomad Dad for the Nomad Capitalist, Andrew Henderson, and we started talking a little bit last time about how we got from here in the mid-60s to where we are 55 years later. So this is essentially over much of my adult lifetime. It's been something of great interest to me over the years. I was in the wealth management business, I was in the life insurance business, and so it was really pretty much my job to know how these things worked and what effect that they would have. Last time we talked about the guns and butter of the 60s and the fact that we had massive social spending with the Great Society programs and fighting the Vietnam War, how that led to Nixon closing the gold window, and then imposition of wage and price controls, and the big inflation we had in the 1970s. And I talked about how overnight money market yields went from 10 to 20%. But after tax, which was a rate of 70%, and after inflation, which was in the teens, you actually lost money on a 20% money market yield. So why did they go from 10 to 20 overnight? Well, we had, in my opinion, and probably in the opinion of many, one of the best Federal Reserve chairmen ever, maybe the best, because remember, the Federal Reserve has only been around since 1913. We had a man named Paul Volcker, who thought that this stagflation was going to ruin the country, because it was doing a pretty good job up to that point, so he slammed the brakes on. And in order to do that, he had to raise interest rates significantly. So that's why the short-term rate, because the Fed controls the short end of the yield curve, not the long end. The long end is the market. Who's willing, in the market, private investors, banks, what have you, foreign governments, what rate do they need in order to be enticed to buy the United States government obligations? But the Fed can directly and does directly control the short rates. So anything a year or less, and he raised those rates from 10 to 20%. And when you have rising rates like that, you're really going to curtail economic activity. And that's exactly what happened. And we had a pretty serious recession in 1981-82. But because he let the market heal itself, rather than rushing in with this program or that program, like all the Fed chairmen have done since him. He let the market work. And it was serious, it was not pleasant. You had double-digit mortgage rates, but by 1983, 84, we had one of the fastest growing economies ever. It was all fixed. Didn't hurt that you had the coming of the baby boom generation. They're now in their 30s, maybe some in their late 30s, early 40s, the older ones, and they were coming of age in their jobs, whether it was the companies they ran, their professions, or whatever it is that they did for a living, and it was a huge generation, and of course, this helped. I mean, that definitely was a tailwind. But I think the key was we had a Fed chairman who did the right thing. He broke inflation, stuck with the program through thick and thin, and let the market work. And as I said, he's the last one to do that. Hopefully he's not the last ever. Things went along swimmingly until about 1987. I'll never forget this. The day before, this is October 19th of 1987, the day before we celebrated Andrew's upcoming birthday, I believe he was going to be 3, at a real nice brunch with his grandparents. The next day, the stock market dropped 22% in one day. Never before, never since, in terms of that percentage. Well, by the end of the year, the market was pretty much back to normal, 2 months later. Why? The new Fed chairman was a man by the name of Greenspan, who at that point I had a lot of respect for. But Greenspan didn't let the market work. His thing was, we will offer whatever liquidity is necessary for the market to function. I'm not sure why it went down. I think there were some currency issues around the world, and that's what led to the selling. By the way, 22% was 500 points because the market wasn't even 3,000 yet. I remember one of the managers that we worked with had the audacity in 1982 to suggest, when the market was at about the Dow at about 1,000, that by the end of the decade it would be 3,000. They thought he was on some sort of hallucinogenic drug. Well, he was right. So this 22% return equated to 500 or so points. But Greenspan, this goes back to 1987, was the first in a long line since then to interfere in the market. Everything was okay for a while, probably for about 10 years, until we had another one called long-term capital management, where it was a hedge fund blow up. He did the same thing there, and ever since, that's what we've done. So we're going 25 years almost now. 35 years almost from that day in 1987 where the Fed has intervened and effectively not allowed the market to work. So this was a big problem. One of the other really good things about the 80s, however, besides the boomers and those tailwinds, was I mentioned in a previous chat with you that in 1980, the top tax rate on income taxes was 70%. President Reagan and the Democratic Congress got it down to 50. And by the time the president left, with the help of Bill Bradley, who was a Democratic senator from New Jersey, great basketball player, both in college and the pros as well, got it down to 28%. This really helped drive things in the 1980s. Now, you do remember from one of those previous episodes I said it's not so much the tax rate that matters, because in the post-war era, the economy tends to grow at about 3.3% a year. That's the kind of the standard rate, the average rate, up until recently, which we'll discuss in another episode. But the key is not what the tax rate is. The key is what's your GDP? Because your tax revenue is going to equal, historically speaking, post-World War II, it's going to equal about 17 to 18% of GDP. So the trick is to grow GDP at a percent. So if 17 to 18% is what you're going to get, whether the tax rate's 90, which it was, or 70, which it was, or 50, or 28, or whatever, you're still only going to raise 17 to 18% of GDP. So let's grow GDP so we can grow tax revenues. And that's what we did a pretty good job of. As always, of course, you ran deficits because we spent too much money. But I'd love to go back to the 80s or even the 90s and have spending at those levels as opposed to what we're looking at today, because this is definitely a ticking time bomb. From the 80s, we went to the 90s. What were the big deals about the 1990s? Well, of course, the advent of the internet was just amazing. That changed everything. And President Bill Clinton was smart enough to realize, if I want to raise a lot of revenue, I'm going to lower the capital gains rates. And of course, the Republicans were happy in Congress to oblige him. And we cut the cap gains rate in half. And so much money came into Washington's coffers that we actually ran a budget surplus for 1 year, because we cut the cap gains rate and all those Silicon Valley people could trade, sell, pay the tax at a 15% rate and be happy as clams. So those are, you know, the great things about having much more of a free market economy. I think that the only blemish was Greenspan in '87, who interfered in the market after the stock market crash of 22% in 1 day. And again, he intervened in '97 with long-term capital management. Not to the extent that we've had after the great financial crisis, but I think he set the tone. And as I said a moment ago, this has been going on now for 35 years, and it really makes it difficult to figure out where we really are. We don't have price discovery anymore. What's this asset worth? You really don't know. We have a lot of zombie companies because, you know, nobody's been allowed to fail because the Fed intervenes. This is a problem. And the same thing is happening around the world, where all the central banks are thinking they have to jump in and save all the companies and print all kinds of additional currency units. But all of this, going back to the mid-60s, we talked about that and the terrible stagflation of the 70s, and some of the policies of the 80s and 90s, even though less so. Those were pretty benign decades as far as interference is concerned. They were probably the two best in my lifetime. But all of this has contributed to where we are today. So next time we get together, I want to talk about the last 20 years, so the last 2 decades, where it's really gotten crazy and we're out in la-la land now. So hope you join us for that next time. Glad you stopped by today. I'm Bob Henderson. I'm the Nomad Dad for the Nomad Capitalist.
How can Nomad Capitalists help you? 4 ways. Number 1, subscribe to our channel and click the notification bell to make sure you get our new video every day. Number 2, get a copy of Nomad Capitalist, the book. You'll learn a lot of my personal experiences over a dozen years of studying this stuff, as well as exactly some of the strategies that you can use to build your Nomad Capitalist plan. Number 3, if you're not sure where to start, but you want to come and learn from my team and I, you want to come and mingle with like-minded people, learn more about our live conference, Nomad Capitalist Live. It's coming up soon. And number 4, if you want some help right now because you've got a burning issue, you need something solved, you want to lower your taxes, get a second passport, or build the Nomad Capitalist lifestyle of your dreams, go to nomadcapitalist.com and click on Become a Client.